I'm excited. I'm actually very excited to be entering the second quarter of the year of 2024. The first quarter tends to be a bit of a riffraff between flows and storytelling. Typically, in the second quarter, we tend to see truer price action confirm. Hey, folks, Serge Berger here, your host of the Steady Wealth Podcast. And what I'm going to walk you through here today, we're going to go pretty quickly here today, as always, is looking at the second quarter and what are some of the themes that we are, at least as of right now, going to be focusing on. Of course, you have to remain flexible in investing and trading. Just quickly, a disclaimer. Also, as always, speaking of disclaimers, anything I will talk about here today is not meant to be financial advice or investment advice. It is purely just educational in our view and research, if you will, but definitely not recommendations or anything like that specifically. The first thing I'm going to do is quickly discuss what happened in the first quarter, just through the lens of the dispersion between the equity market and what we saw in the bond market. And the best way to discuss that, or to maybe quickly share that, again, if you're watching this on YouTube, you'll see the chart. If you're watching or listening to the traditional YouTube channels, traditional podcast channels, you won't see the charts. Don't worry, you won't miss a thing. I'm just going to talk about it. But let me just start off with sort of the base case, or really what happened in the first quarter. As we came into the first quarter, there was just a tremendous amount of continuity from what we saw in Q4 2023, and essentially that's momentum. And I actually think we're in a momentum mania in the market. The way we measure momentum, the way we measure market sentiment, I have not seen this level of market sentiment this bullish in probably 17 years. And to me, this is a place to be cautious in certain parts, but other parts of the market actually really, and that's what we're going to talk about here. Last week, we talked about the top 3 charts for the week ahead. Some of those charts that we went through, including energy, small caps, and others, I think are also going to carry into the second quarter here and going to be prominent themes. But just quickly starting off on the dispersion between in performance and what that might mean heading into the second quarter. Again, in the first quarter, we saw a lot of chart chasing. The S&P 500 closed the first quarter, so the first 3 months of the year, up a touch over 10%. The aggregate bond index, or the bond market, U.S. bond market, if you look at it in aggregate, was basically roughly flat for the month. So what that basically means is, for an institutional investment manager, they are now going to have to rebalance their portfolios if they haven't already done so at the end of the quarter. They're going to have to start doing this here quickly at the beginning of the second quarter. And basically what that means is that they will probably be selling equities to bring back the equity exposure back in balance, because again, the equity market had such an outperformance, which basically means that the equity portion of the portfolio took on a bigger part. And then they would have to, with selling equities, they'd have to buy some bonds to again bring that back into balance. So sell equities, buy bonds. Now, of course, the question is, and this is it's difficult to quantify this, at least for me. The question is that going to put enough selling pressure on the market to start breaking things like the S&P 500 below its critical 21 period moving average, which is one I continue to point out, and I'm going to point out again today as being just a critically important level for the market, just as far as the algorithms are concerned. We talked about this last week. Again, I'm going to quickly reiterate it again. We have not seen the S&P 500 break below its 21 period moving average for more than a day or so, which to me doesn't even count, basically since October of last year. You can do the math. That's November, that's December, that's Jan, Feb, March. That's 5 months and going. Typically speaking, we will see in any given year a couple of 5% corrections. And I say corrections in loose terms. To me, that's 5% doesn't even scratch the surface of being a correction, but at least 1 to 2% moves. What's important here, and again, I mentioned this last week, so I'm going to reiterate it here today. A 2% move from the levels we're at right now. I'm recording this here just before the beginning of trading on April 1st, 2024, so beginning of the second quarter. But at this point, if we were to see a 2% move in the S&P 500 on any given one day, we would be below that 21 period moving average immediately. And I think that is where the levels start getting interesting, because once you have that, you start going from 2 to 5% down. That would get us to probably about 500 on the 5,000 on the S&P. And then probably there, it quickly leads to 6-7%. Maybe we get a 10% move. And I think then the market will be in a better balance where we want to start buying things again. Which gets me to just a couple of points here. Everyone's talking about how the market is strong, and that's true. There's no doubt momentum is strong. But momentum has also started to wane. So if we, for example, look at momentum as a factor and divide it by, let's say, the S&P 500, we very quickly see that the momentum ETF, the MTUM, which is a popular ETF that holds those momentum stocks, has actually basically been making lower highs, and it topped out in early March, so not quite a month ago. In fact, versus the small caps, it's actually basically been flat performance for, I think, almost 2 months now. So momentum is definitely stalling. And if we look at other momentum stocks that were momentum until they totally fell apart, like Lululemon, just want to quickly point out to this, Lululemon was a stock that could do nothing wrong from October last year until about early January. Then it started to stall, and then basically it absolutely collapsed after earnings in March. And that is, I think, the risk of a momentum trade. So if you're listening to this and you long momentum stocks, and I get it, we want to be long the trend, just know that typically when momentum ends, there will be plenty of single name stocks within the momentum buckets that completely get their heads cut off very quickly. And that will lead to, again, the momentum and the factor exposure that is momentum to change its face very quickly to neutral, maybe bearish, until it becomes bullish again at some point. To me, when we look at the second quarter, I really think what we're going to focus on here is, again, I think I want to be underweight right now heading into the second quarter. And this is not a recommendation, as always, just what we're looking at. I want to be underweight the S&P 500, certainly the momentum part of it. Because again, I think momentum is very long in the tooth. At the same time, I do want to be long, or overweight at least, things like the energy market. The energy sector, if you look at it particularly through a weekly chart or even a monthly chart, it is bullish as all hell. There are secular trends there. There are structural bullish tailwinds. There's really nothing, in my view, not to like about the energy market. Now, and this is important, I don't think if the S&P 500 were to pull back 5 or 10%, that the energy market would be unscathed and will continue to go higher. I don't think that's going to happen. I think the energy market too, energy stocks, the XLE ETF, and individual energy names, oil, will probably pull back, just because as people have to de-lever their portfolios, they will start taking profits where they can and throwing out the proverbial baby with the bathwater. And so as we start to play that out, though, through the second quarter, I would imagine that energy stocks and gold and other things that are going to offer as a good hedge if we own them, that's important, if we own them as investors against rising in inflation, is certainly rearing its ugly head again, stronger than people, at least I think, than stronger or people that some people are care to admit. And so we want to be long that. So coming into the second quarter, the way I like to look at it here is underweight the S&P 500, just because the S&P it's rallied so strong. Long energy, long gold. Again, I want to be clear. I'm not saying energy and gold will go higher without a pause if the S&P were to correct. I do think they'll come down, but they probably won't come down as much as the broader market, and there'll be better buys again at that point. So does that mean we have to micro time this and not be long energy and wait for the S&P to correct? I will leave that up to everyone. Again, I can't give financial advice, nor do I want to. But the way I'm looking at this is to just not be in any levered positions at this point, meaning certainly not levered momentum stocks. But even on the energy front or gold, I don't want to be levered long. I personally own a lot of the GLD ETF. I have some energy exposure, but none of it's levered, meaning I'm not long futures. I'm not long options. I'm basically just long the ETFs, basically. So the XLE or GLD, but I'm not long levered. I will add leverage if and when we start to see the broader market pull back a little bit. Again, the S&P 5, 10%. Again, I think that's very healthy. And maybe on that front, gentlemen, mention this again. A lot of people are scared of these pullbacks. Like 5 to 10% in the S&P would be extremely healthy at this point. People think that would not be healthy. It actually would be very healthy because it shakes out some weak hands, gets the market a time to reset, and then we head into the summer months and start going into the political parts or the more political parts of this year as we head into the U.S. election and see the economy start to churn and do its thing as interest rates remain fairly restrictive, at least in my view. Some people have different views on that. So I think the long and short of it here as we head into the second quarter is to be cognizant of the fact that typically what worked in the first quarter doesn't necessarily continue to work in the second quarter at the rate at which it has. So again, momentum stocks. I do not think momentum stocks have it in them to continue at the rate at which they have. I think a lot of people are going to get really badly disappointed. I am sure the second quarter is going to be hurtful for lots of momentum traders that are just long, but I also think that people are going to be hurt by not being correctly positioned in things like energy and gold and maybe some Bitcoin. Again, that's a bit more controversial there, but they all have, there's a theme there. I'll show you a couple other points here. And again, if you can't see the chart, just know that I'm showing you bullish things here. I think something like copper, there's an ETF for that, CPER. These are trends that they're not going to go to the moon immediately, but there's an underlying bid in these kinds of things. So whether it's adding some exposure here or waiting for a broader market pullback and then adding it or adding some copper exposure or maybe some leverage in it. That's my plan, right? I'm long some of these things right now, but I'm not long with any leverage. There's no way I'll add leverage at this point, even in something like copper or like gold. We've talked about this now for weeks and weeks. I think gold, the GLD ETF, again, I don't see why we can't go to 230, 240 this year. Again, though, I will warn, right? To me, I don't want to be levered long gold here. I want to be in GLD or some other non-levered way of doing that. But I don't want to be levered long. I would like to add leverage if we see a pullback. Again, that's an if, that would be a gift. I don't know. I can't time it right now, but I'm aware of the market of the market correlations as risk gets unwound if momentum stocks start to give a more meaningful pause. So I guess that's my game plan for the second quarter. The other things I want to quickly touch on bonds yields. To be honest with you, I'm more and more comfortable that bonds anywhere between, let's call it 3.8 and 5 are in a point where they're not going to freak the market too much in the longer scheme of things. However, I do think that if the bond market, and I've been saying this now for many weeks now, if the 10-year yield were to break and hold above 4.4%, 4.35, 4.4, I think it would be an initial excuse for the equity market to start being a bit more nervous. I don't think it's going to crash the market. Again, 5 to 10% is garden variety that doesn't even register on any scale. But I don't think the market can quote unquote crash if we stay within the 3.85%. And it's clearly visible right now, by the way. Again, I talk to people, institutional investors, but also you can see how the market reacts within this band. It just doesn't really care. If the Fed starts to announce that they're going to cut no rates this year, that'll be troublesome. If they start saying they're going to start cutting rates a lot because the economy starts to suck and bond yields ultimately drop below 3.8%, that won't be good for the equity market either. I think, again, to summarize, I'm extremely excited to come into the second quarter. I was not excited coming into the first quarter, and I think I was quite vocal about that. I'm typically not excited about the first quarter. As I said at the beginning of the podcast here, the first quarter to me is always a bit of a shit show, excuse my language. Again, fun flows, chart chasing, but also you can get extreme emotions in either direction. You can get ugly sellouts in the first quarter and a lot of just irrational moves. Not that the market's ever very rational in my view. The equity market, I should say, other markets are much more rational. But heading into the second quarter, I think we'll start to see some more reasonable moves, maybe some more mean reversion, whether it's equities or, again, some of the other markets that we talked about. That's how we're looking at it heading into the second quarter here, folks. Any questions, as always, email support@thesteadytrader.com. If you are looking for an investment advisor, we would love to talk to you. Go to www.bluemarlinadvisor.com. And there's a free survey you can take there as well, for a free risk tool that you can assess how risk averse you are as an investor and trader. With that, have a great start to the second quarter, and we'll talk to you real soon. Thanks for listening.